Imagine walking into your bank tomorrow morning. You hand the cashier $100. She smiles, she thanks you, and you leave feeling richer because your money is safe. But here's the question nobody asks. Where exactly is your money? Is it sitting inside a giant vault, waiting for you? Protected, untouched, exactly where you left it? Or did your bank already give your money to someone else? Because the truth is, the money you think you own might already belong to someone you've never met. And once you understand how banks really work, you'll never look at your bank account the same way again. This isn't a conspiracy. It isn't illegal. It's simply how almost every modern bank on Earth operates. And by the end of this video, you'll understand why banks desperately want your deposits, how banks create money, why even the biggest banks panic during bank runs, how the Federal Reserve influences the entire financial system, why the world's wealthiest investors understand banking better than almost anyone else, and why the entire global economy depends on one invisible force: trust. So before we uncover what really happens to your money, let's begin at the very beginning. One ordinary Monday morning, Alex walks into his local bank and deposits $1,000 into his savings account. Simple, right? That's exactly what almost everyone believes. Most people imagine that once the money is deposited, it simply sits inside the bank, safely locked away, waiting until Alex decides to withdraw it. Almost like placing cash inside a giant safety deposit box. But that isn't how modern banking works. Banks don't work like giant piggy banks. They work like businesses. And businesses hate money that sits still. Imagine owning a warehouse filled with expensive machines, but never turning them on. It wouldn't make any sense. For a bank, money is no different. Every dollar that sits idle is a missed opportunity. Money has only one job: to move. The moment Alex deposits his $1,000, the bank doesn't simply store it. It now becomes part of a much larger financial system designed to keep money flowing throughout the economy. And that's where the real story begins. Now, imagine Sarah wants to buy a new car. She walks into a dealership, finds the perfect vehicle. But there's one problem. She doesn't have enough money to pay for it. So she visits her bank and applies for a loan. A few days later, the bank approves it. But here's the question. Where did that money actually come from? Did the bank owner pull out a personal checkbook? Did another customer give Sarah permission to use their money? Of course not. The bank uses customer deposits, its own capital, available liquidity, and its lending capacity to issue new loans. And in that moment, Alex's deposit becomes part of something much bigger than a simple savings account. So, if Alex deposits his money into the bank, what's in it for the bank? The answer is surprisingly simple. Banks pay Alex a small amount of interest for keeping his money on deposit. At the same time, they lend money to qualified borrowers, like Sarah, at a higher interest rate. Imagine Alex earns 2% a year on his savings, while Sarah pays 7% on her car loan. That difference, after covering the bank's funding costs, operating expenses, expected loan losses, and other costs, is one of the main ways banks earn a profit. Multiply that by millions of customers, and you begin to understand why banking is one of the largest industries in the world. Everything works smoothly until people lose confidence. Imagine that one morning, a rumor begins spreading across the city. people hear that their bank might be in trouble. No one knows whether it's true, but they don't want to take the risk. Hundreds of customers rush to the bank, then thousands. Everyone wants to withdraw their money at exactly the same time. This is known as a bank run, and it's one of the biggest fears in modern banking. Can the bank return everyone's money at the same time? Under normal circumstances, yes. Every day, banks handle thousands of deposits and withdrawals without any problems. But banks don't keep every deposited dollar sitting inside a vault as physical cash. Instead, they keep enough cash and other highly liquid assets to meet expected customer withdrawals, while the rest of their balance sheet is invested in assets like mortgages, business loans, car loans, government securities, and other investments. That system works because not everyone withdraws all of their money on the same day. But if everyone suddenly does, even a healthy bank can come under enormous pressure. So, what happens when a bank suddenly needs far more cash than it has immediately available? Selling loans overnight isn't easy, and waiting for borrowers to repay their mortgages or car loans could take years. So, where can a bank get cash quickly? In the United States, one possible source is the Federal Reserve. Often called the nation's central bank, the Federal Reserve helps keep the financial system functioning by supplying liquidity to banks when needed, under specific facilities and conditions. It doesn't exist to rescue every bank from every mistake, but when the financial system is under severe stress, its actions can help prevent problems from spreading throughout the economy. Here's something that surprises most people. In today's economy, most money doesn't exist as paper bills or coins. It exists as numbers inside bank accounts. And when a commercial bank approves a new loan, in many cases, it doesn't hand over a suitcase full of cash. Instead, it typically credits the borrower's bank account with a new deposit. At that moment, new bank money enters the economy. That's why economists often say that commercial banks create most of the money people use every day. But they can't create unlimited money. Their lending is constrained by regulations, available capital, liquidity, risk management, and the demand for credit. Every time you tap your debit card, send money through a banking app, receive your salary by direct deposit, or check the balance in your account, you're trusting that those digital numbers will still have value tomorrow. Because modern banking isn't built on stacks of cash. It's built on confidence. Confidence that your bank will honor your withdrawal. Confidence that borrowers will repay their loans. Confidence that the financial system will continue working. Remove that trust, and even the most advanced banking system in the world begins to break down. So let's put it all together. Alex deposits $1,000 into his bank account. The bank combines Alex's deposit with deposits from millions of other customers, along with its own capital and other funding sources. Using those resources, and while staying within regulatory and financial limits, the bank makes loans to qualified borrowers like Sarah. Sarah uses her loan to buy a car. The dealership receives payment, the employees get paid, suppliers receive new orders, businesses invest and hire. As money continues moving through the economy, some of it eventually returns to banks as new deposits, and the cycle begins again. That's how modern banking helps support economic activity every single day. The next time you open your banking app, check your account balance, or deposit money into your bank, you'll know that modern banking is far more than a place where money is stored. It's a system that helps move money through the economy, connecting savers with borrowers, helping families buy homes, helping businesses grow, creating jobs, supporting investment, and keeping everyday commerce moving. Like every system, it depends on responsible management, sound regulation, and above all, trust. Because in the end, banking isn't really about money. It's about confidence. And confidence is one of the most valuable assets any economy can have. Thanks for watching.